The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we wrapped up the month of April on Wednesday with a little bit of support coming back into corn wheat. Soybeans under some pressure, and we found pressure in livestock, and most of the outside markets had a lower day too. Was a lot of this that end of the month position squaring at play? Was it other factors? We're going to talk about that. Joining us now for a conversation, Mike Zuzolo with Global Commodity Analytics here on Market Talk. And Mike, good to have you with us for our midweek conversation, end of the month conversation, technically. And, overall, I would say it was a mixed bag on Wednesday. I think one of the key things that we always get at the end of the month is economic data. I know we're going to dive into a lot of that today and tie it in with the grains and the livestock trade. But just overall, it felt like kind of a mixed bag on Wednesday.
Yeah, it did. And I like what you said a minute ago about the end of the month and positioning. I think that between the economic data and the May delivery first notice day coming in on the grains at the end of the month, which is kind of odd. Doesn't happen very often, Jesse. I think the trade was out of position on a lot of their markets and a lot of their spread trade. And I think that's why we picked up a lot of steam in short covering in wheat and to a lesser degree corn, and really pushed the downside in the soy, because the soy product deliveries were extremely large between the meal and the bean oil, while the corn and the soft red wheat were very, very light. So that's just another added thing about these end of the month reports that can really influence the trade. And it'll be interesting now because we've got an end of the month in the middle of the week. We don't have the end of the week close, but the monthly charts are closed out. So could be quite a bit of fireworks here between Thursday and Friday.
Yeah, it could be very interesting to see what some of that money flow looks like, or does it look like. And I think a good basis for our discussion today, you sent over some charts that we'll pull up on the video feed. Let's talk about the U.S. GDP numbers. Those came out on Wednesday. We also got the PCE numbers. We got jobs data. We got all of this economic related data. And I think the big thing I saw with the GDP, Mike, was we saw a little bit of contraction. I mean, talk about what you found with the GDP numbers and give us a bit of the breakdown.
Yeah, the GDP number chart here is a really neat one from Reuters because it shows the specifics of what made up GDP for the first quarter of 2025. And it came in at negative 0.3%. The vast majority was the 5% negative number in imports. When I saw that, Jesse, and comparing that to the estimates of a plus 0.3%, I should have put a 0.3 instead of a 3% in there. So correction there. But between that and the fact that the imports did this to us, we're really one step closer to a global recession, with the United States not holding up the rest of the world like it has the last 2 or 3 years. That GDP number going into a negative territory on the report today is the first time we've seen that since 2022. So now we're back to levels in terms of economic growth not seen since the pandemic. And so it really sets the stage for some big issues when it comes to demand, consumption, the consumer sentiment, a much more price nervous and price sensitive consumer, whether it's food or clothing or tennis shoes. It really opens up the door to a summertime that could be very, very volatile. And fortunately, we have lower energy prices right now at the gas pump. But this is a big deal as far as this GDP being down in negative territory this early as a result of the imports, which obviously is the negative reaction by many commercial accounts and many companies to the tariff policies that we put in place.
Well, let's talk about China a little bit and weave them into this discussion because seeing a GDP contraction here for the US, China's PMI data, we have that as well. Pull that up on the video feed. And, the back and forth between the US and China here, Mike, and China, rolling out some videos, saying they won't kneel or whatever the case was there. And just this continued back and forth and the friction and how things have been going and more and more. There's been a lot of talk about China's economy. So when you look at their PMI compared with our GDP, for instance, I mean, what stands out to you with some of this data right now?
What stands out is what you just said as far as the frictions and their economic problems. And when you add those two together, it really opens up the door to a damaging commodity environment for those commodities we rely upon China for, namely soybeans and cotton and sorghum especially. In this PMI data, you have both a non-manufacturing, which would be services like banking, and then you have manufacturing in your factories. You notice that orange line, which is the manufacturing, Jesse, is down to 49%. 50 is neither growth nor contraction. So it's the zero line. And so they're in a deep contraction now in manufacturing, again, to a level not seen since the pandemic. The non-manufacturing line that's in light gray, it's saying 50.4. But if I had to guess based upon keeping track of China's other key services that they've seen lately and the domestic consumer, I think it's probably just below 50 as well, and also in contraction. So now this sets the table for the number one and number two economies of the world really having difficulties now economically. And it really also sets the table again and reinforces the idea that we are really very close and one step closer now to a global recession led by those two largest economies. And so you and I have talked about this quite a bit. I put a lot of stock in President Trump's 100 days of his presidency and getting things evened out and ironed out with China in terms of the trade relationship. We are what seems to be a long way away from that. And if we don't see something in the very quick, immediate future, we're on a pathway, I think, to really hurting our soybean commodity demand in particular, because we are getting, as you alluded to, very entrenched and dug in terms of our positions between each country.
Let's talk about soybeans here. Perfect segue into that. And, we look at this soy complex the last couple of days here to end the month a bit lower. I guess it begs the question, Mike. I mean, we've seen this rally in beans and now a couple lower days. I mean, is this an area where we should think about doing some hedging or not? I mean, what do you think about this soy complex to finish April?
That's what I'm doing, Jesse. I tell you, it's one of the most critical time periods in my career, and I don't say that easily or lightly. In June of 2018, the lead month soybeans went from essentially where they're at right now, with a high of about 1026, down to 858 within 1 month, and we went sideways for several months after that, and never really climbed out of the gutter. For probably another 6 or 7 months, if memory serves me right. This is the type of scenario that I'm very nervous for, but this is also the type of scenario that's almost near perfect or very ideal for getting risk management and protection in place in case you have another 2018. And what this chart really shows very easily is how the domestic ending stocks and stocks to use ratios, which are uncannily similar to where we were back in 2017, where we are right now, went sharply higher in 2018 by about a 10 million metric ton net decrease in China's soybean imports. And that then created a stocks to use ratio of about 22.5% and ending stocks that ballooned from about 400 million bushels all the way up to 900 million bushels. I think, simply put, Jesse, you've got to sit down if you're a producer right now and say, do I plan for this or not? And do I have a chance to go from essentially 1030 in the lead month beans down to 860? And if I do, why am I not getting prepared for that?
Mike Zuzolo, Global Commodity Analytics, joining us here today for a conversation. Wheat and corn did have a slightly higher day on Wednesday. When you're looking at the wheat markets here, Mike, I know weather has really been at play here at home and in the Black Sea region. As we move into the month of May, what are you really focusing on in terms of the wheat right now?
It's a very simple question, and we've had this several times in the last 3 years with it comes to price. We're back down to near $5 now with the lows in soft red wheat this week. Crop conditions jumped 4 points in the nation, and we're really right with where we were last year. And the trade is seeing okay demand. I think it's better than okay. Our U.S. exports are up 15% right now in terms of year-to-date inspections for the wheat overall, Jesse. So the question really is the wheat overdone in the price to the downside? Yes, if you're looking at the global outlook, you're looking at this map, you're looking at this drought map that shows the precip or soil moisture levels from 0 to 40 centimeters for Ukraine, which the dark red area is an extreme drought. That's one of their key wheat producing areas. Some of the extreme dark red areas of Russia are also key wheat producing areas. The April wheat exports right now, as it stands for Ukraine, are going to be down about 10% from April of last year. Their corn exports sales down about 18% from last April for the month. And so if you look at it globally, we are very undervalued in the wheat market. If you look at it domestically, maybe no, not so much, because we've got a good crop being grown right now, and the rains really came in a timely manner. The tiebreaker for me really is China. The central southern areas of Chinese wheat plain growing areas are in a very significant drought. Not terrible like what we're seeing in Ukraine, but it could be very bad as we get to the May time period, extremely critical growth time period. So if China continues to stay dry, I think that really opens the door for quite a bit of short covering in the wheat complex. And when we talk about wheat, we got to talk about corn. I think one of the only reasons why the corn market is down right now at this stage, other than the planting progress getting caught up, is just this wheat collapse that we've seen here the last 6 days.
Good thoughts. Good thoughts. Let's talk livestock here before we wrap up today. Cattle ended their futures run of higher sessions on Wednesday. We were moderately lower. I have to wonder, was it end of the month consolidation type of trade, or is it just, we're getting to lofty levels here. Maybe we're hitting that ceiling again, or is it tied to some of that GDP type of news that we talked about at the top of the segment here, Mike? I mean, talk about the cattle complex on Wednesday.
Yeah, this is this is a clinic on technicals. These cattle markets right now, seasonals, cycles, and technicals. And to answer your question quite bluntly, Jesse, I really have felt strongly that as the April, which is provided the rocket fuel in this live cattle market, even without the help of feeders at times, to yet another new record high as it expired on Wednesday, getting to 217.67, was yet another situation where the April, as it expired and lost its volume and open interest, it really took a second back seat to the other contracts. And so June took over, and in real practical terms. And that's what we're looking at in this chart is a June daily chart. And you've got a trend line in orange that we've broken through that goes all the way back to the April time period, as far as the major low made back in late March, early April. And then we have right below that price action for today's close, a blue trend line that's flat that depicts where the old highs were back from earlier this year and earlier than in the springtime. So we're at a really critical juncture with a more negative technical look in the flat price, and my approximate 40-day cycle that I've kept track of in the June contract is really suggesting there's a lot more reasons to be a seller than a buyer. And then the last part of this chart is the bottom of the oscillators, suggesting pretty strongly at this stage that we're getting a potential sell signal, which would suggest new sellers coming in more likely than new buyers. And so I really feel like fundamentally, seasonally, with this kind of a run we've seen in the April market, And then you look at these technicals, a setback is very likely. You just don't know how much of a setback. And I think that goes back to what we talked about earlier in the top of the show with the GDP and with China. What kind of pork market are we going to have? Are we going to get any business from China on pork? What kind of a beef market are we going to have from Asia? Are we going to get any trade deals from Asia? What kind of a dollar market are we going to have? Is the dollar going to become a safe haven again? And so I'm really focusing hard on soybeans and cattle right now for getting protection in place, loving every minute of the cattle because of the price we're at, not loving every minute with the soybeans.
How about the feeder complex as well? I should ask you on that side of the cattle ledger. Let's take a look at the May feeder daily chart. What stands out to you in feeders right now?
Oklahoma City cash had a very nice week again this week. It was $5 to $10 higher for steers. We could have a situation where the feeders pick it up and lead the cattle higher, or at least keep us higher. I think this chart would suggest otherwise. It looks very similar to what we just looked at in the June fats. We're breaking through a key trend line drawn off those same lows, and the stochastics are rolling over into what you'd call a sell signal. So I'm going to give the feeders a little bit of a chance to find some support and get that support from the cash market in the next week or so. But keep in mind, we went to 217 plus in April fats. How much more can we tolerate in the cash negotiated market? I would say right now for the summertime, I put 220 as the top end for what the consumer can tolerate in the cash cattle market, or what the packers will pay based upon that consumer. So I think we're getting a cap in the fat cattle. I'm going to give the May feeders a little bit of time, but historically May feeders not the greatest contract to lead the show to the upside.
All right, Mike, final thoughts from you today. Great stuff as always. What would you leave folks with here this week?
Well, going back to what we've talked about over the last 2 months, Jesse, and essentially since February, is we've got a trade war with China in place. We think we're out of the woods with Mexico and Canada, which is very big for agriculture, but we still don't know about Asia. So we've got those three things to juggle right now. The big thing within all the three things has been the dollar has been going down and down and down, and keeping commodities, U.S. commodities, very much in play and very much bought on weakness. That still is the key for me going into the summertime, as far as whether we open up the downside or remain in a pretty volatile, violent trading range when it comes to the grains. When it comes to the meats, it's a little bit more clear cut. Funds are still long, and the consumer is going to get hurt based upon these GDP numbers. And I think jobs data is really key when it comes to the meats now.
Mike, if folks want to reach out to you for a conversation or to look at your analysis, what's the best way?
Best way is globalcomresearch.com, and that's globalcom with 2 M's research.com. Get a free trial on there, or take a look at the toll-free number. Give me a call if you have a specific need or piece of research you'd like me to do.
Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Thanks for joining us this week. Appreciate it.
Thank you, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.